Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 23rd, 2018. I'm doing this video after the markets have closed, so this is the weekly wrap, and we'll look at some levels and things that we can expect next week, and more importantly, going forward in the coming weeks to months here. Kind of a mixed bag, which I'll go over today. I mean, all in all, bad day, down day in the markets. But I want to cover some key levels, where we close, which stocks or indices closed on or near support, and which ones broke below support, because we do have again some key indices like the S&P 500 closing below key support lines, long-term trend lines, and we have some others like QQQ here, which I'm starting out on the weekly chart, closing right on key long-term support. So again, we call it a mixed bag. Now, make no mistakes about it. The charts clearly, with all the divergences in place on the weekly and daily time frames, I still think there's, plenty more downside to come in the coming weeks to months. It's just more of a matter right now, when do we get the first kickback rally? We'll jump back to the 60-minute charts. Shame on me for, I had taken some hedges yesterday and then again this morning around that 163 level as we had potential divergences, thinking we might get the kickback rally there. No big deal. Basically, I just gave up. I was a little overhedged, so would have been a nice, day on my, with all my swing short positions. That was washed out, and I did pull the plug, and I posted that on the site in the trading room. When it was clear that 163 and 162 were going, I closed half my positions, and I actually took a little bit home with me Monday to come back partially hedged, but again, if where I'm kicking myself is if you watch my analysis over the last week, other than the last couple updates on the market analysis, I added some lines here, but back then I was focusing on this 164.54 level is really where the cues needed to hold, and we would probably get a bounce. And what I had said at the time, and I said this I believe in a couple videos, is that if we started to move down to that level and beyond there, that the selling would likely accelerate. And that's exactly what happened. And again, shame on me for not just sitting tight and trying to game a counter trend bounce, but again, it's that's trading. You win some, lose some. Very often, I can get those kickback rallies and then recycle back in. At the very least, I was comfortable at least coming into today hedged, and like I said, wish I would have pulled those hedges off. Well, in hindsight, if you can go back in hindsight, I would have never hedged up. But either way, one day, there's still plenty of money to be made in this market. I think in 2018, it's going to be a trader's market, swing and trend traders. There's going to be plenty of opportunities on the long side as corrections really, stocks tend to fall fast when they hit a key support level. The economic indicators, a lot of the things in the economy are still strong, although that will start to shift. Remember, what a large driver of the economy in recent years has been the wealth effect. The Fed did that intentionally. They brought rates down to a near zero interest rate policy and all the quantitative easing to do one of two things. Number one, to spur growth in the economy. Low rates, you borrow money, and companies borrow, and they're supposed to put that money to work. The idea, at least historically, has been companies would then go out and build a new manufacturing facility, finance some operations expansion. Well, as we all know, what most of the companies have done with this free money or low interest rates, they turned around, sold bonds at next to nothing, and used that cash to buy back their stock, which further, inflated this bubble that the Fed has caused. Then the other thing, and the Fed did this intentionally. It's been in writing. We all know this if you study the markets. By running rates down to near zero, they did, which in my opinion, almost borderline criminal. They forced conservative investors, grandma, out of her, CDs that used to pay, 5% a few years back. You can go into the bank, get a 4 or 5% CD. Even before that, 6, 7, 8%. When I was back in the business as, first as a stockbroker and working in bank channels as a stockbroker investment advisor, that's where the rates were 5, 6, 7%, and even higher, before then. But so what happens is when interest rates go down, safe money like CDs drop below 1%. And this historically happens. You can go back any point in time. Money moves out of those safe haven investments, went into dividend paying stocks, junk bonds, anywhere people could replace, especially those on a fixed income, as well as pension plans that need to have a certain return. It forced a lot of money into the stock market, and so now we're going to start to see the unwinding of that. And it's going to take years. Yeah, that's my opinion. I don't think we're going to see a 2008. I've already said that again before several times in the past, but I think we'll see a prolonged bear market. And right now, I just want to say this that we're still technically hanging on by a thread. The long-term indicators are still bullish, but I'll also say this: by the time all the long-term indicators slip to bearish, we've already dropped 20% or so. Let me just say that's the longest term. Intermediate-term indicators, most of those are actually still bullish right now. Those tend to turn a little quicker, and of course, we're on sell signals on just about every short-term indicator, and I don't have time in this video to go over that. I just wanted to cover some key levels, and again. That's what we've seen, as prices started to get back here. We saw the selling accelerate. I put a line here, a couple reactions here, some reactions back there. And more importantly, we're going to move out to the daily and weekly charts and just give a quick recap of what happened today and what may happen next week. All right, this is QQQ. There were those trend lines that, these are pretty significant trend lines. The QQQ closed just above there. There's also that 156.40 support level just below. And when we go to the weekly chart, as we started out with here, you can see here's that weekly uptrend line I've been talking about, and you can move it around. I had it like there before. You can play around, try to capture the most number of reactions. You can see a lot of reactions here. So I think, even if I had it here before, that's not what I call a solid close below. So what I'm going to do is move this here. It captures a lot of the reactions. Remember, the markets are dynamic, so is my analysis. Trend lines, support levels change, and you need to adapt as the charts go forward. So this is where we're at. We're in a precarious position now on QQQ. SPY has given up the ghost. This is the SPY, or the S&P 500 is a more diversified index, and this is our first weekly close or solid weekly close. You can see, again, modify this trend line a little bit. We closed right back above it there. But we now have what I call a solid weekly close on the SPY. We even closed below that key 40 week, which is a 200-day moving average right there as well. Now let's just take a look at a few of the components and we'll wrap this up. But if you want to know bigger picture where I think we're headed, it's this level. This is what I've talked about before. This was the top. This capped that large sideways trading range from 2014 into late 2016, where we broke out and back tested, and then it led to this leg up. And it's I look at the volume at price histogram. I look at a lot of other things. Volume price histogram here. I'll show it to you. Turn this color up a little bit. This shows where trades have occurred. So you can see there were a lot of trades within here because it was a multi-year sideways market. And this is what we call a thin zone. So logically, although there's going to obviously be some counter trend rallies along the way, barring anything spectacular in the markets, which I don't see, this has all been priced in the charts, I think we work our way down here in the coming months, and that is on SPY. I'll give you that number. That's 214.05, and that would constitute a drop of about another 17% or so from where we're at right now, and which will, from the highs, that'll put us into official bear market territory, 25% drop off the highs. But like I said, it's more a matter of, if you're long-term trader, there's still a few stocks that are clinging to support right now. And I'd be remiss not to point that out. So let's just go over those and we'll wrap this up. All right, back to, we're on the SPY. So what I'll do, here's the components of the SPY. I'm just going to cover a handful of the big names. Apple, which is also the top component of QQQ. This is a weekly chart. One of the most important things on Apple, and I have another chart on a different charting program that shows it better, is this 40-week moving average, which is a 200-day moving average, the red line I just tuned up here. It has done a phenomenal job of defining bull and bear markets. In other words, when Apple's in a bull market, it's above that 40-week moving average. and when it's in a bear market, it's below that. You can, again, it's hard to make out on this chart. I do have a white chart, and I'll share that. I've posted on the site before. In fact, you can just go on the site, use the ticker, or there's an advanced search function now. If you type in Apple AAPL, you'll go to the search page on the right. I've added a new Google search. It's an additional search function, so you can type in Apple 40-week moving average, those key terms like you do a Google search, and it'll pull that up. And there's a long-term trend line off the 2009 lows that has not been violated. And so what I wanted to point out is Apple, this was a brief whipsaw. As with any trend indicator, when you're using exponential moving averages or even trend lines, you can sometimes get a brief whipsaw signal. That's what we call it, like we had that candle there, but then we snapped right above that 40-week moving average. But Apple is still there right now. So Apple hasn't completely given up the ghost yet. Let's look at a daily chart. I certainly think it's headed lower, but there's the daily chart, and I've gone over this quite a bit lately. And maybe you're new to my analysis, but this is it. We had a breakdown of this rising wedge pattern on the daily chart with a divergent high, kickback rally, back tested, and now we're moving down impulsively following the back test, which helps to confirm the technical, validity, if you will, of this trend line here. The fact we broke down, fell off sharply, rallied right back to it, back tested it for a little bit, and then moved down again. And here's that excuse me, I had to pause the video for a second. Here, by the way, is the 200-day moving average, again, which is the same as a 40-week moving average, because you have 5 days in a week. So therefore, if you divide 200 on a daily chart, divide that by 5, you come up with 40. So that's why the 40-week moving average is the same as a 200-day moving average. All right, so let's tune that back down again. I don't like to put too much up on the chart, at least not have it pop out. It kind of takes away from, at least for my eyes, some of the more salient features. If I think that's important, then I'll turn that level up at the time on the chart. But let me go ahead and turn the volume at price bars back down and continue on. So there's Apple. Trend indicators, we still have the PPO signal line above the zero line, which indicates the trend is bullish. But again, this chart just tells me it's just a matter of, where are we going to get these little counter trend bounces, and do you want to try to trade those, or do you just want to sit tight? If you shorted Apple on the breakdown, on the back test, or even after it started rolling over, if you're willing to ride out the counter trend bounces, I think it's going lower. Amazon gave up that support level I covered earlier today, pretty big down day. It's now below this bearish rising wedge. So that one doesn't look so good. But here's Alphabet. Let's just look at this on a weekly chart. That trend line will show better. This is a very, very well-defined trend line. This goes back, I just jumped over to a weekly chart. And guys, if I don't make mention, I know I do these videos, I try to talk fast, but if I don't cover it, the time frame of the chart is up here. You can see GOOG weekly. And you can also see the date down here on a yearly chart. I just have the calendar year. I don't have the months in there. So this goes back to the 2009 lows, numerous reactions. This is a very technically significant trend line, and Google has not given it up yet. It's also, you can see the 40-week moving average there. It's done a pretty decent job of also defining the trends on Google, acting as support during uptrends and resistance during downtrends. And so there's another stock that has not yet broken down. But why I say not yet, these divergent highs, although nothing is 100% in trading, this is a very large part of my trading incorporates divergences, both bullish and bearish. And this tells me it's only a matter of time before this trend line breaks. So to me, it's more so a matter of, do we get another kickback rally? Was the selling this week it for now? Do we pop next week, since we still have some of these stocks above trend? But whether we do or not, I think ultimately this one goes lower, and quite a bit lower. Microsoft is also, you have a minor, what I call a minor uptrend line. See this trend line pretty well defined, and this is what I refer to as the primary trend line. This purple trend line down here captures some of these reactions. I do need to tighten that one up a little bit. That's a little off. Let's do it this way, and captures these reaction lows, that reaction low. We might, you can play around with it. Again, trend line drawing is more of an art than a science, but either way, that's where we're probably going to go once this trend line cracks. But again, this is Microsoft, one of the biggest components of the S&P 500 as well as the NASDAQ 100. As ugly as this, the price action has been over the last couple of weeks, it is still above trend. And as I like to say, support is support until unless broken. Berkshire, similar looking chart. And you're going to get a lot of that, even though Berkshire has nothing to do with Microsoft. Berkshire's a financial company. Microsoft's a tech company. They're all these big names. What they have in common is they're the leading components of these index tracking ETFs, and there's been such a huge trend towards indexing in recent years that a lot of inflows to the S&P 500 index funds and the Nasdaq 100 index funds. Um, that money gets spread amongst the large holdings, and that's why these charts look very similar. So there it is. You can also see the 200 or the 40-week moving average doing a good job of defining the trend here, and you can see this minor uptrend line very well defined. A lot of reactions along the way. We'll tighten it up a little bit here, and we ever so slightly closed below it. Yes, that is a close below, but not by a very large margin. In fact, if I really want to clean this line up, we'll capture that right there. So you can give it the benefit of the doubt. Now, it doesn't look good. I'll just say that. And there's quite a few stocks either closed right on or just below. And if and when Berkshire takes that out, look for some support down here around this trend line. I'll only cover a few more because I've covered a lot of these in the past. Facebook, another big component, not a good looking chart. This is a very important trend line. I won't even call this the primary uptrend line. This only has a few reactions off the back in 2012 after the stock came public, and it's a trend line that I think will likely come into play, but we don't know. We'll have to see a reaction on it to validate this trend line. There's only been a couple reactions back here. This trend line is valid, and you can see we've only had one intra-week break, but no zero closes below that trend line until this week, and this is a big impulsive close. So see what I'm seeing here again. This is a mixed bag. We're seeing some market leading stocks breaking down. That is an impulsive breakdown. That's an impulsive red candle and a pretty solid close below there on a weekly basis. So there's Facebook on breakdown mode. JP Morgan Chase, one of the largest financial companies in the world, obviously, and you can see it right now. Clean that line up a little to capture these reactions. You see it starts back here, reaction there, and it closed right on support. Now it did so with a bearish rising wedge pattern. It's close to the apex. So again, I have very little doubt, although there's no certainties in technical analysis or trading. Um, just looking at this chart, I have a high degree of confidence that it's just more of a matter of time, as to when this trend line in this wedge breaks. And that can be Monday morning on a gap down if futures tank over the weekend, when they start trading on Sunday night, or we can bounce and have another thrust up and another rally. I don't think we're going to see new highs again. I think the QQQs, that high we recently put in after the correction in January, early February, I think that was it. But we'll see. We'll take the charts as they come. Let's just see what happens. And that's about it. Bank America starting to crack below its comparable rising wedge pattern, but not by a whole lot. And I'll wrap the video up with just going over a few more that I haven't covered as much recently. I keep covering the big names: Apple, Facebook, Alphabet, Microsoft. This is Intel, still one of the largest components of the Nasdaq 100, and it has clearly broken down below this wedge type pattern here. This trend line looks to be headed to those levels. I think I did cover this one today, and I told you where that's going in an earlier video. Here's Cisco. Haven't really updated this daily chart, but you can see the divergence here, the negative divergence at the most recent high. And let's see if I have anything on the weekly. No, I don't. So we'll look at Comcast. This is also a major component of the NASDAQ 100. There's a trend line. You can see this one has broken its long-term trend line but quite a bit. Had a little false breakdown, one last thrust to a divergent high, and it's clearly rolled over. So this is a lot of market leading stocks have started to break down, but some haven't yet, and they appear to be on the verge. Nvidia, there is a lot of thin air under this one when it finally breaks. This is a nice bearish rising wedge pattern. There's a trend line, and you can see it again. This is a common theme that I'm trying to make here, that after the close today, the weekly candles are finalized. We have some of the market leading stocks breaking down, but others at support. And I could flip a coin as to what'll happen on Monday. I'm still Although we didn't get the bounce I was looking for today, and again, it wasn't much of a bounce. And I also told you my convictions weren't that high on it either. I wasn't betting it hard, and I didn't have a strong conviction. But if I had to guess, I'd say we will have a little bounce on Monday. If you're looking for the market to match the recent highs to get out of longs, if you're trapped in those, I don't think it'll happen, but anything's possible. We'll take the charts as they come. And, should we have a big, giant gap down on Monday? That's not going to be good because it'll put all of these leading stocks that I'm covering here below trend and on these weekly charts. And given it's weekly charts and all that matters is the weekly close, but the farther we drop at this point, the more you start to have stops run. You start to have the institutions, which are so top heavy on these leading stocks. There's so much indexing. And like I said, it worked great on the way up. Money flows into the index ETFs. But when people start, they turn around, go the other way, they start pulling money out of their 401k, out of their index funds. It doesn't matter how good the fundamentals for Amazon or Nvidia or any of these companies are. They are met with forced selling. That is part of, it's a double-edged sword being a top component or any component of the Nasdaq 100 and these major index. So again, if I saw a bullish chart out here, I would let you know. But these are, in recent weeks, I was focusing a lot on the 60-minute charts, and I told you I would be turning my efforts or my focus more and more to the daily and weekly charts, and that's what I'm doing here now. And doesn't look good for longs, but if you are comfortable with short selling, or even like I've done some videos recently on relatively conservative ways to short via the short ETFs without using leverage. And at the very least, time to maybe hedge up your portfolio, take some profits. That's what we're looking at here. We're looking at some pretty ugly charts, guys, but they're still, like I'll use the term, we're sitting on the edge of a technical cliff, if you will, with the markets. So they need to rally now, and they'd have to do quite a bit to undo what's in these weekly charts. And it's not going to happen. I could tell you, no matter what happens next week. I don't care if the market is up, 10% for the week. It's not going to do that. But if it was up 10% for the week, it still would not undo the bearish technicals that are in place on this chart. So it could delay the inevitable, but the inevitable says a lot of these stocks are coming back down, like I said, in 2018. So hang in there and if you don't know what to do, go to cash, start lightening up. You don't have to make drastic decisions. What I usually do if I'm caught on the wrong side of a trade, I'll start scaling out. I'll set some stop loss orders to stagger out. You should have a plan ahead of time, but I'm talking now for long-term positions. This is time to start paying attention to your 401k money, things like that. I'll let you know when the longest term trend indicators roll over and when all these stocks have broken down on the weekly time frames. But like I said, by the time that you hear on TV that we're in a bear market, that means the market's dropped 20%, and that's usually when those long-term indicators. And I'll add one more thing, and then I'll wrap this up. Because of this huge advance in the market, keep this in mind. Because of this huge run-up, the long-term indicators. Gosh, I could flip it to, if I flipped it to my, let me try something real quick. Yeah, this isn't going to work so well. And I have different layouts, and what I'm usually doing in the videos is capturing a very small part. I have a pretty large monitor, so I capture a small part of that with the screens. This is one layout, and I have to compress it down, so it's hard to make it out, but I'll try to show you. This is my monthly trend indicator. This is a monthly chart of QQQ up here, and essentially there's different trend indicators I use. The 10-6 period exponential moving average has done a great job of defining bull and bear markets. There you go. I actually expanded that. You can see back here, for example, this was the dot-com bubble, that great bull market leading up to the March 2000 highs, and the trend indicators told you we were in a bull market. And, these are long-term trend. This is the longest of my long-term trend indicators. So it's going to give you a sell signal well after the top. However, these are much higher probability sell signals, and as you can see, and so this is basically just a 10 period and a 6 period EMA, and I also use this ROC, rate of change 13, as a additional confirmation. And what you're looking at here is when the 6 period EMA crosses down below the 10 period, this histogram just shows you visually when those lines cross. So in other words, they crossed right here, and so the histogram goes red, and the ROC I have it in histogram form too. So what it's saying is bear market, green is bull market. Obviously, we've had, the bull markets are longer than bear markets. Here's that late 2007 to 2009 bear market. And again, these indicators capture the bulk of that. What I was trying to tell you is this has been such a powerful bull market. These long-term indicators are so deeply entrenched into bullish territory that it would take for them to flip anytime soon. We'd have to have a virtual meltdown. Um, we can't have another Black Monday like we did in 1987, where the markets dropped 20, I think it was 21% one day. That can't happen anymore because of circuit breakers. We can get there, relatively quick. You can go down every day, hit the circuit breakers. They stop trading, they shut it down for the day if if it hits a certain level. And I don't see that coming right now. I just want to say that it would take some catastrophic black swan event. So it's probably going to take us months before these longer term trend indicators roll over. Then the rest of these charts on here, then it goes down to a weekly trend indicator where I use 43 and a 17 EMA, and I plot it down here in a histogram form. We had a little whipsaw signal there. In fact, that drop back then, we had if I'm not mistaken, the Nasdaq the small caps and the Nasdaq may have come down to a 20% bear market correction level real quick, but for the most part, this has been a super strong, mostly unidirectional bull market. So these trend indicators, like I said, are very well entrenched into bullish territory. So it's going to be a while if you're a trend follower. I know a lot of people out there. I it's saying bugs me is the trend is your friend. Well, the trend is your friend until it's not. If you're following trend indicators and you're waiting for sell signals, this market could be down 30% or more before the longest term trend indicators confirm you're in a bear market. So you need to really focus on this is a daily intermediate term trend. You can see divergence there. Again, I just use different 50 and 20 period EMAs here. And then I have a very short-term trend that just once again crossed. It was bearish recently, bearish back here. These shorter-term trend indicators tend to get you long or short quicker or confirm a breakdown. But they're also more prone to whipsaw signals than the long-term trend indicators. You don't want to see this trend indicator go bearish, these weekly or monthly trend indicators, but they will. They will. This is one of the longest bull markets in history, and um, statistically speaking, we are going to see another bear market soon, and probably long and drawn out. So again, it's just we'll revisit these trend indicators later. Let's just watch those technical levels that I talked about now. On these market leading stocks as well as QQQ and the SPY, and this can help us, navigate, decide if you want to exit longs, when to get out on any bounces. Um, and also when to short or add to short exposure. Like I said, where we closed today, it just wouldn't be prudent to add we closed at too many key stocks as well as the index closed at support after being pretty oversold in the near term. And although we can't rule out the possibility of a waterfall type sell-off like we had back here in 2015, we had that flash crash back in 2010, big drop in 2011. Those are all certainly possibilities, but if so, the downside is going to be relatively limited before we have a decent bounce. So that's what you might want to look at is look for the next bounce and to maybe exit some long positions if you're in those right now. All right, we'll leave it here. Have a great weekend, guys. If you enjoyed the video, please give it a thumbs up on YouTube.